Hi, I'm Howard Marks, co-chairman of Oaktree Capital Management. I'm here today to lead a discussion of the emerging markets with our senior portfolio management in each area. Julio Herrera, who's head of our stressed and distressed emerging market debt activities. Pedro Urquidi, who's in charge of our distress activities in Asia specifically, but every place outside the US. Frank Carroll, who's a portfolio manager in our emerging market equity activities. Before we get into detailed questions, obviously the overarching concern, the obsession, is the virus and its effect on the macro environment. We're not macro investors, but we all have to couch our thinking against a backdrop. What is your personal slant on what's going on? How do you factor it into your activities, starting with Julio?
Sure, well, thank you, Howard. We've been looking at the coronavirus and following the spread of it across emerging markets. And the way we've looked at it is really from two sides. First, from those countries that are well linked from the global manufacturing chain to China and trying to look for opportunities, distressed and dislocated investments that could end up suffering from a change in the nature of global manufacturing. And the second way we've looked at it is to try to identify those credits that can become dislocated because of their sales to China, be it iron ore, precious metals, soy, soft commodities.
Pedro, what about yourself? How are you thinking about the setting?
Really, a lot of what we did early on was look at what responses China was going to implement to the spread or initial spread of the virus. And frankly, as we tracked the different initiatives that the Chinese government has implemented, we've seen that if anything, China is going to work its way through it. And you've seen the spread obviously slow down in terms of its effect. You see a lot of the larger companies coming back to work post the Chinese New Year holiday period. So I think in the end, from a China perspective, will be an unquestionable effect. But that effect, I think, is being addressed specifically in specific ways by the Chinese government, which should ameliorate it. Now, the knock-on effects for the region and for specific sectors and for travel and for all these other areas, I think those still remain to be seen in terms of how long it takes for the rest of the world to get rebalanced and stabilized vis-a-vis the delayed effects that are now hitting Western Europe, for example, the US, and other parts of the market.
You mentioned the slowing spread. Certainly the actions that China took seem to have been working. Frank, what about yourself? How are you viewing the overall macro environment?
It's a remarkable time. We're certainly getting a demand shock now because of the global virus, and then we threw an oil shock on top of it. Those shocks have definitely caused valuations to fall. I mean, we're talking to our companies constantly. We're looking for opportunities. We want to buy good businesses in this, but frankly, the visibility that we're getting is low. Hopefully we'll find some investment ideas and we'll move forward with caution.
Last year was a very strong year in emerging market public equities, which is your area of responsibility. Tell us what's the MSCI doing, and you might share about the performance of China this year and over the last 12 months.
MSCI was up about 14% last year. We had a trade war last year amidst all of the other noise, and China performed very well. We've had a virus that began in China this year, and actually China on a rolling one-year basis has significantly outperformed the US. But other countries within the emerging markets have had currency weakness, et cetera. That's really what's dragged the MSCI down. It hasn't been China, it's been the other countries.
Are you doing anything of note in your portfolios? I mean, is there any protective action you should be taking today and are taking, or is the horse out of the barn? Are you now preparing to profit from this, or is it too early?
We tend not to get very defensive. We like to say that we invest to make money. So we're not the ones who are going to crowd into utilities or telecoms, et cetera, and try to just be safe. We try to take advantage of the market opportunities and buy good companies at better prices. Some really quality companies are moving towards the cheaper end of their historical ranges. We'll get a chance to add companies that previously might have been a little bit too expensive for us.
Are there specific actions with regard to the virus? Maybe the answer is that it has hurt some companies more than we think it should have, and that gives us buying opportunities. Anything else?
In terms of direct plays on the virus, airlines are very light in emerging markets. Consumer discretionary names are down a bit, but those had been typically on the higher end of valuation anyway, so we weren't very overweight there. The impacts are really coming from global decline in interest rates, global decline in energy prices, and I think a global GDP slowdown. That's where the impact will be for us.
Julio, my suspicion is that your markets held up relatively well, maybe because it had enough negatives factored into it in advance for non-virus reasons. Can you tell us what's up?
Sure. I think overall the market has held up a little bit better than U.S. high yields, for example. But I think it's mainly started with a fair degree of complacency going into it. And in terms of the markets that we're involved in, we've yet to find value. The first thing that happened, I think that really triggered a move in EM debt was the conflict that has ensued between Saudi and Russia. And that was quite a crude awakening for the market, if you will.
Is that a pun?
Well, maybe.
Good one.
And so what I saw is a great deal of illiquidity in the marketplace. So it's been very difficult to really find much paper that's become dislocated. And it's usually the first initial shock in a dislocation is, both parties back away, buyers and sellers. And the banks really are not making liquid markets like they used to 10 years ago. So we haven't been able to really first find much in the way of markets that we can function in. And second, valuations haven't really gone down as much as we would like for our type of buying with a fair degree of margin of safety. What we're seeing is, as Frank mentioned, is that the dislocation so far has been primarily in the oil patch, the state-owned companies first and foremost that have too much leverage for our taste at this point, so they're not cheap enough. And second, the airlines. And as Frank mentioned, there's not very many airlines, a few national carriers. But if you look at the amount of debt on them and the leases versus their cash flow, they're highly levered. And so there's nothing really appetizing for us yet. And we hope that, from our point of view, since we're distressed investors, we hope that if there is a triggering of a global slowdown, it seems like the world is decelerating for the moment, that should bring us more opportunities.
Pedro, we have been increasing our activities in Asia and particularly China. That's caused you to move to Hong Kong roughly a year ago from London, expand your staff, expand your activities. We've been gradually investing more, not in public debt. Can you tell us about your activities and what's going on this year, what's happened in your market and what you're doing?
Absolutely. Well, look, when you look at the global distress market, as we like to think of it, and you look at where there's pockets of opportunity or areas where there's a significant amount of distress and stressed debt, and you map it out, at least from our perspective, the area that stands out very clearly as being a great opportunity from a private markets perspective is China and India. The scale of it is tremendous. And within China, you have about 1.7 trillion of distress and stressed debt. In India, you have a couple $100 billion of distress and stressed debt on the balance sheets of the banks and the NBFCs. NBFC means non-bank financial corporation, which is really, in essence, the shadow banking system within India. And if you look at those two pockets and you add those two together, there isn't a market that I know of today that has that scale of problem debt on the balance sheets of the banks and other financial institutions. So that really led us to move resources, allocate more time and focus to the region. And China, I guess one thing that I would note, unlike other parts of Asia, China has levered itself very significantly post the GFC, in that if you look at the non-financial debt to GDP ratio, it's now today higher than Europe. It's also higher than the US. That was not the case back in 2008. And if, in terms of our focus on private markets, the reason we focus there is because that's where the scale of volume is. And if you take China specifically, there's been a very concerted effort by the Chinese government to help increase and accelerate the deleveraging campaign within the country. So we built a dedicated localized team in Hong Kong and Singapore to focus on China and India. And within that, we've been able to tap into a variety of interesting opportunities. Once again, the fundamental credit crunch that's occurring with the deleveraging that's starting to happen in both China and India. We made some very interesting loans on assets, primarily real estate-related assets in China, as well as in India. And in those two situations, we've been able to get attachment points which are not possible in other markets. And I would say the quality of the assets are as good, if not better, than what we've been able to do historically in Europe. So fundamentally, I think there is opportunity. The private markets react much more slowly. It'll take time for these private market opportunities to reprice, so to speak. Fortunately, we were able to structure investments which we feel quite comfortable with in terms of margin of safety, in terms of structural considerations, legal considerations. We think we're well positioned to weather the storm, and we'll look to invest additional capital opportunistically as we see the right opportunities at the right pricing deck.
While we're on the subject, we might digress for a minute. When people around the world hear that you're a buyer of bank loans in China, I'm sure a meaningful fraction say, you know, how dependable is the rule of law, the process? And you've had some experience. How do you think about the process of achieving satisfaction as a creditor who's been unpaid?
You know, I've had experience in China going back to the 1997-98 time period when I was actually located in Hong Kong. If you look at the development within a Chinese context, the legal system, it has changed dramatically since that time period. But that being said, there are very big differences between how the legal system works on paper and how it works in practice. And more specifically, if you look at how the legal system works as it pertains to relating to privately owned enterprises or private businesses versus state-owned enterprises. We focus very much on privately owned enterprises or private holders, private borrowers versus anything that's state-owned. And if you look at the types of investments we've been making, a lot of it is real estate backed in the end, in terms of NPLs, in terms of the new lending. As we've worked through these pools, we've been able to see the actual flow through of the legal system as it pertains to accessing collateral, as it pertains to negotiating with courts, with borrowers. And, you know, I feel, you know, quite confident that, you know, the system works as long as you stay in the Eastern Seaboard and as long as you do your diligence appropriately.
Let's talk for a minute about the interest rate environment in which particularly Julio and Frank are operating, and what's been going on with policy regimes, and do you see any change?
I don't think we've seen a lot of change yet, but what's really interesting, I think from the sovereign and from the company point of view, is over the last decade, as Julio was mentioning, in terms of cleaning up balance sheets and risk profiles, there's been a lot of refinancing into local currency debt, which means that the external shocks of the currency movements don't matter like they used to, which is better for us because we can have an exporter with dollar revenues and local costs that will go lower because that will, you know, improve because of the currency. And on the other side of it, they're less risky because they don't get squeezed by big dollar movements on their debt side. That's a big difference for us.
What about you, Julio?
Well, you know, I generally agree with that, but the caveat I'd add is that given that the one thing that John Bull can't stand is 2%, and there's been a lot of chasing of yield in the world, as Frank points out, maybe the Brazilian government may have gotten a little bit ahead of itself by dropping rates when economic demand and inflation were slowing. And so when I look around the world today, I see very little in the way of monetary room to be able to lower rates and resuscitate the economy. Furthermore, on the fiscal side, other than China, no one really has the firepower on the fiscal side because they're running fiscal and current account deficit. So it's a very delicate moment for the world to have had this sort of combined both supply and demand shock. And rates may not work this time around, but we'll see.
Oil and other commodities are extremely important in the markets you deal in. Your companies have taken quite a knock in those regards. What do you see? What are you doing about it?
I mean, the good news is energy is only about 5% of our benchmark now. Energy has actually fallen quite a bit. And 7 or 8, 10 years ago, it was 20% or something close to that. So energy as an overall component of the emerging markets benchmarks is a lot smaller. We are seeing indiscriminate selling. Where there are 2 Russian oil companies. One has a very clean balance sheet, has been doing buybacks, and has increased their dividend, has a very low lifting cost. It's down 30%. Its peer has a very heavily leveraged balance sheet. It's also down 30%. We will be rotating into, obviously, the first one.
I think it's really important to note that in times of chaos, people don't make fine distinctions, as you indicated, vis-a-vis the 2 oil companies. There's an old saying that in times of crisis, all correlations go to 1. Mm-hmm. Correlations don't always deserve to go to 1. I think it was mentioned the benefit to India of the lower oil bill. And I think that India has a major problem of its own with the NBFCs, but has not been identified so far with the virus. How do you view the opportunities in India, and is there anything to do now?
Well, in India, as you pointed out, I think the headline is not COVID-19 at this point. The real headline is there's a very significant credit crunch going on in the shadow banking system. And that really started a couple of years ago when one of the largest shadow banking lenders defaulted on its debt and ended up needing to be restructured. Since then, you have a whole market or a whole part of the lending fabric which has become less active. Has run into specific liquidity issues. Because if you look at the NBFCs, they grew from close to zero, say 15, 20 years ago, to be about 350 billion size balance sheets. They were doing all the lending that the traditional state-owned and private banks were doing previously, prior to the buildup of their problem debt. And now, for a period of time, they had very easy access to lending, or to be able to borrow and finance their longer-term loans, in the sense that they no longer can access this borrowing. So they're being forced to raise equity, being forced to look for alternative lenders like ourselves, frankly, in some regards for parts of their portfolio. We're trying to lock down a few very interesting opportunities that have been in our pipeline. And this dislocation that's happening globally, I think, will help us on the margin to get the pricing we want and to lock them down as the new opportunities. Shifting
to the subject of risk, our mantra has been move forward, but with caution, as Frank indicated, for some good period of time now. How have you implemented that in your portfolios to date? And in short, is it working?
For us, we have always insisted on a very large margin of safety. In terms of how we're implementing, it's really never been any different. I mean, we move through the same methodology throughout every type of market cycle, and we're looking for, first, companies that have very robust balance sheet. In fact, more than 20 to 30% of all of our target companies that end up in our portfolio come from investment grade or from split rated and highly rated high yield. So we're trying to take advantage when there's market dislocation and there's adverse selection in portfolios. So the first principle always is a good balance sheet, high quality balance sheet, good business. Second, we're looking for some type of FX neutrality, be it because they're an exporter or they're able to index their domestic currency revenues in real terms. Third, if we can, to find those special companies that do exist in EM that have fairly inelastic demand profiles. Finally, the other 2 characteristics that we've been using as we move forward has been looking for those companies that, first, are willing to pay. It's very important because that can be quite difficult in EM. And second, those that generate a lot of cash flow, that would put them in a situation where they could pay even though they're going through some type of either macro or industry or specific idiosyncratic issues with their existing business.
And what about on your side? You're dealing with regimes that an outside observer would be tempted to call uncertain, undependable,
right?
And yet the creditor's position is one of getting paid what they're due. How do you deal with that uncertainty in your stressed and distressed EM debt?
Well, I think the cornerstone of that, and I think Frank would understand this quite clearly, is that we're looking for companies that have a great deal of equity value underneath the debt, whether it's recognized by the market or not. And there's often dislocation of very high quality companies. We haven't seen much of a spread to developed market airlines or developed market oil companies or shale or anywhere that's really gotten us to the point where we're ready to sort of pull the proverbial trigger, but it's getting closer.
Pedro, you have money, in theory, that you could spend. The coffers in our distressed debt funds are available to you. I don't hear you moving ahead a great deal.
The part of our portfolio that we focus that's related to emerging markets, China and India, most of our efforts have been very much focused on the private markets, and it takes time for them to correct, in essence, and it's time for those deals to end up getting closed and restructured and recut to reflect the current environment. So that's correct. We're not specifically deploying more capital in the current environment. And as you know, we run a global strategy within our distressed debt strategy. So we're reallocating our incremental dollars to where we see the bigger correction happening, and that's in the public markets in the US and elsewhere, a little to a lesser degree Europe, but more the US. So that's one of the features of our global distress strategy. We've always been nimble and flexible, shifting our capital to where we find the best relative opportunity of the vintage and of the specific time period in question. But one more thing I'll note, I think back to a little bit of your question that related to risk management and how you look at capitalizing opportunity when it looks like there's less opportunity broadly. For me, it's always an exercise in making sure that there's a reason and a driver for opportunity. In Europe, 10 years ago, a big driver was the deleveraging that was happening. From a European context, that is very advanced now. We're probably 3/4 of the way done. Asia, or China and India specifically, is just at the beginning. And that's why we knew we had to build to be positioned appropriately for that deleveraging. And once you have that component in place, you have maybe not immediately, but over time you'll have sellers. You'll have hopefully sellers outnumbering buyers, and we'll be able to get the types of discounts that we're used to getting when you have appropriate dislocation.
It's music to my ears. Frank, you run essentially fully invested, but you're contemplating some rotation.
Yes, it'll be rotation for us. I perhaps find myself a little bit envious of Julio and Pedro here. But our risk management is try to own the best companies in the first place, weather the storm, and be extremely quick and disciplined about cutting mistakes when a thesis breaks. And frankly, some of the theses are getting challenged these days, and that will lead to the rotation.
I guess I'll wrap up with my last question for all three of you. It's about something we don't engage in that much at Oaktree, which is crystal ball gazing. Of course, the virus started up in China. The early spread was to Singapore and then South Korea. Now the attention certainly has moved on. The new cases have moved on. To what extent do you think that EM markets will be highly affected in the future by the virus? Is it going to be a big topic when we meet, or a minor matter?
Well, I think it's going to be pretty bifurcated. There are winners and there are losers here. As Frank mentioned, China, India, South Africa, Turkey will do well because of lower oil prices. They are consumers of oil, and if that goes on for quite some time, it'll be quite beneficial for them. And when things are beneficial, we never remember them. On the other hand, Mexico will suffer because their production is falling and oil prices are falling, so P times Q looks bad for them. They'll probably have to lose their investment grade rating soon, and this gives the rating agencies quite a pass since oil prices have collapsed. Argentina will suffer because it had export hopes of being able to export oil and gas, and that's off the table for now. And there are a few others that really, like Colombia and Ecuador, that are suffering maxi devaluations as we speak, because they're very dependent on oil. So I think that's really where the trigger has been transmitted from, say, just a plain flu to almost a chronic disease, transmitted through the oil price to some of these oil producers.
Pedro, what does your crystal ball tell you?
Well, as you mentioned, we don't typically use crystal balls, but I'll try to conjure mine up at the moment. In my mind, I frankly don't believe that the COVID-19 virus, at least for China and India, in the end, or a year from now, I don't think we'll be talking about it.
What about you, Frank? You're dealing with a widespread of countries, and you're dealing with markets that react in real time.
we do have the flexibility to avoid problem countries. Frankly, we're a little bit concerned about India, not only because of the virus, but India has definitely been in an economic slowdown, and as Pedro mentioned, has its own challenges. So we'll be light there. We will be concentrating on China and Asia and the rest of the emerging markets. I do hope we'll find some opportunities in Brazil. But the bottom line is our companies overall have better balance sheets, I think have better governance, and have better managements than they have probably in the entire time I've been doing the emerging markets. Valuations have come to the low end of historical ranges now, thanks to the sell-off. So it's a better entry point for us in a lot of places, and hopefully we can capitalize on that.
Good. Well, I'd like to thank my colleagues, Julio, Pedro, and Frank, for taking part in this discussion with me today. I'd like to thank everybody who's watching for joining in. It's a pleasure having you with us.